Hello traders, welcome to this video on the descending broadening wedge pattern. So this is a chart pattern that you can look for on your charts, which will help you identify reversal trade opportunities. I've already marked one off here on this pound dollar 1 hour chart. What you're looking to do is to find lower highs and lower lows. You can mark them off with your drawing tool. So you will see a resistance level here and a support level here. As you can see, I've marked the lower highs and the lower lows. And this has formed the broadening wedge pattern. And that's because it's in the shape of a wedge. And as the name suggests, it's broadening, i.e. getting wider. So the purpose of this chart pattern is to try and identify key market reversal points. In this instance, we are looking for a downtrend so that we can mark off these levels, see the pattern, and then look to trade on a breakout of the resistance level. So after it was formed, and we would have been around here somewhere, we would have marked our levels and we'd be waiting for price to travel up to this area where we would hope for a breakout. And as you can see, it played out perfectly. We could have taken our entry on the breakout either straight away, or we could have waited for the candle to close above the resistance level of the descending broadening wedge pattern. And had we taken the entry, let's just say on the candle close for argument's sake, well, I mean, I'll have to zoom out to show you, but you can see this move, it was worth almost 350 pips. So I'm sure you'll agree that would have been a great entry point, and it does show the strength of the wedge pattern when marked correctly on your charts. Just bear in mind that this is the 1 hour chart time frame. If you try to mark this on the lower chart time frames, whilst it will work on occasion, it may be less reliable simply just because there's less price data included and maybe less traders watching that particular pattern. Some of the big players, institutional traders, will be looking at the higher chart time frames, which is why I prefer to use them. I just find the signals more reliable on the 1 hour charts and above. It also means less time chart watching, less costs in terms of brokers' fees, spreads, commissions, less chance of slippage. You just need to have sensible money management, as always. So talking of money management, say we did take the trade here on this breakout of the wedge pattern. I mean, that spinning top there was further confirmation. I do have a video on spinning tops and other candlestick patterns you can check out. It's just good to have plenty of different methods of analysis to confirm good trades and to confirm when not to take a trade. So if we entered here, we could have placed the stop loss, well, on the other side, plus a buffer of the resistance come support level. So, anything 10 pips. Some traders may want to go all the way down here on this area of consolidation, but 50 pips, which I personally think is quite high. You'd need to get 150 pips on the trade, where this did go 150 pips, for a favorable risk to reward ratio of at least 3 to 1, where a winning trade is 3 times that of a losing trade. You wouldn't necessarily want to have a 50 pip stop loss and then try and take 20 pips, because one loss will wipe out 2 plus winning trades. So try and keep the stop loss tight as possible, whilst giving the trade room to breathe. And yeah, this would have been a great trade. We could have moved the stop loss to break even, just in case the price did turn around and take us out. We wouldn't have been in a loss, or we could have closed some of the position around here and then move the stop loss up to lock in some more profit. Basically, the point I'm trying to make is you don't really want to just leave your stop loss here if price comes up around here somewhere, because if it does end up falling, you had put the potential of 120 plus pips and you end up in a loss just because you didn't have a money management strategy in place. You could close some of the position, half the position, let the rest run, which would have been a good idea to let the rest run. I mean, it would have been a good idea to leave it all, to not close any of the position, but move the stop loss all the way up to maximize the trade. So for example, after we've seen this consolidation here, and we'd wait to see how it played out, and it continued upwards, so we would have moved our stop to just below the support level here, lock in some profits. Same thing happened here. We could have again moved our stop loss and just followed the trade up, and there would have been signs here that it's time to exit anyway. You can see all this consolidation. We might have considered closing the majority of the position and just leaving the rest, just to see if we can maximize the trade. But either way, you still would have had a good amount of profit from this trade using the descending broadening wedge pattern. I personally wouldn't just trade this pattern on its own, although you can. Sometimes I think that simple trading is the best. There's no need to overcomplicate things with various different technical indicators which can be lagging or just showing you the same thing. I mean, for example, we could use a moving average to show that this is a downtrend, but we know it's a downtrend because we've marked the levels. You can just look at the chart and see that, okay, let's zoom in. I mean, you can just look at it and see that that's a downtrend. So with the broadening wedge, the descending broadening wedge pattern, you're looking for this downtrend. Lower highs, lower lows, and then we're going to look to take the breakout in the opposite direction. Again, price action for confirmation, good money management. Yeah, you wouldn't. Yeah. So there you go. That's just one of the many chart patterns that you can keep in mind, mark on your charts, just to make you aware of what's going on in the market, maybe help you decide which direction you're going to trade in. Even if you're not going to trade the breakout, you might say, okay, I see price has broken out, it's probably going to head upwards, and then use other indicators for taking trades on this uptrend. For example, let's have a look at, put the stochastic oscillator on the chart. Basically with this indicator, if you don't know already, you're going to look to buy when price is in the oversold zone and or the main line is above the signal line, ideally on a crossover in this oversold zone is what most people would use as a stochastic signal. The opposite is true for a sell trade. Crossover in the overbought zone of the main line and the signal line in a downwards direction suggests that the market might be turning. However, for example, you can see here there was a crossover in the overbought zone, so people might have thought to jump in on this on a downtrend, but we know from this pattern that we've seen form here and just from looking at the chart that it's in an uptrend, so that might not be the best idea. However, if we look at the crossover in upwards direction in the oversold zone, we can see that this is in confirmation with the descending broadening wedge pattern that we've identified here. We've had the breakout, we've waited for the pullback, the stochastics confirmed an entry, so we could have taken it there. Let's move along, another potential entry there, the stochastics crossing over in the oversold zone. So you can see how there's various different ways you can look to take entries using the stochastic crossover. Okay, that's a good example there. But again, always keep an eye on price action, support and resistance. I mean, you know, the stochastic could even be used, you know, this was a downtrend here, so you could have used it for a sell trade if you wanted to trade within the descending broadening wedge. So the crossover there in the extreme overbought zone suggests market is going to fall, and it did. So you could have been taking advantage of both the downtrend here and the uptrend following on from there. You know, you maybe wouldn't have taken this particular stochastic crossover there or even there just because you know, okay, the resistance is there, support is there, we're sort of in the middle of no man's land, whereas this one was close to the resistance. You know, spinning top candlestick patterns, support level and a breakout down. So there's many ways you can use the broadening wedge pattern, and in combination with other indicators, and most importantly, in my opinion, price action, support and resistance, and as always, good money management. Hopefully you found this video useful. Please like and subscribe for more. Thanks for watching.